In this session, let's focus more on corporate governance, which is mostly to do with the set of rules and policies and procedures to make sure that the individual investor, his particular rights are protected, or the company's management is acting in such a way that it benefits the shareholders. So, all those things more to reduce the gap between the shareholders and the management of the company. So, these are some of the things that we will be covering as a part of this corporate governance aspect. So, let's look at a few of these elements. It is one of the most essential things for a companies to operate efficiently, because most of these companies they attract funds from individual shareholders who do not play any big role in the day-to-day operations of the firm. So, but they have a share in the profits. So, to make sure that the company is performing very well in line with the expectations of the shareholders, it has to have a set of corporate governance practices. So that's the reason we say this is one of the most important aspects from a company's perspective if it has to work very efficiently. Though I may not say that the existence of corporate governance will bring profits, but the other way I like to put it is, if the corporate governance is not present properly, or it is ineffective in a particular company, it can threaten the very existence. Obviously, if it is good, it can result in increasing in the value, but only corporate governance may not increase the value in isolation. Probably it is like corporate governance along with the proper business planning, all these things will definitely boost up the value of the firm, but all the other things in place, but corporate governance is lacking, it can pull down the value of the firm and it can even threaten the very existence of the firm. That's the reason whenever we talk about corporate governance, the major focus is to resolve the conflicts between the management and the shareholders. Because shareholders are the people who are the investors in the firm in the form of shares, whereas when we look at the management, they may or may not be possessing any number of shares of the company. They are employees who are being hired to do the day-to-day operations of the business. So there is likely to be a kind of a conflict of interest between these two sets of parties, and the corporate governance, the rules have to be directed towards the individual shareholders rather than towards the interests of the company. So, and again, I cannot come out with one set of corporate governance practices uniquely for every company, because it depends on the legal environment in the country, the culture of the organization, the industry in which the company is operating. But of course, there are a good set of rules which can be commonalized across the industries, across the countries. So at least those are some of the things which every company need to stick to, and of course anything that is specific to that to its own business, even those things have to be incorporated as a part of the typical corporate governance mechanism. Whenever we talk about effective corporate governance, we look at it from the two dimensions, the key objectives. Whenever I say a company has implemented an effective corporate governance practice, it should target to reduce the conflict of interest between the shareholders and the management. The key objective any conflict of interest existing between these two parties, the management as well as the shareholders, try to reduce it to whatever extent possible. That is one of the key objectives of effective corporate governance, because these are the investors, whereas these generally are the employees, but employees with power. So employees want to execute tasks which are of their liking, whereas the investors want the employees to perform those tasks which will benefit them. That is what is the main reason for a conflict of interest. So any corporate governance practice that is set up in the company should be targeting towards removing or even reducing this kind of a conflict of interest between the parties, and the usage of the company's assets to the best interests of the investors. Let's say the company's assets are there, could be in the form of fixed assets, the buildings, the plant, the machineries, the vehicles. So those are all company's assets. Use them not for the personal purposes of the managers and the executives, but let them be used for the benefit of the individual investors. So those are the key objectives with which the corporate governance practice takes off. And so as a part of effective corporate governance mechanism, we see that the company should define what all rights the shareholders have, in what all aspects can they question the management, what is the kind of right they have with respect to the operations of the company. That entire thing needs to be documented as a part of the corporate governance process. It also should talk about overseeing responsibilities of the managers. How do the managers what are the responsibilities of the managers, the board of directors. Document that entire set of roles and responsibilities at each of the layer and communicate that to every shareholder, because whenever we use the word board of directors, it is that group of people who are appointed for each company, and their main role is primarily to take decisions or act on behalf of individual shareholders. So they are not a part of the management. They are the ones who are representing the individual shareholders. So obvious, but people who know how the businesses work. So very clearly the plan should talk about, the corporate governance plan should talk about what are the roles and responsibilities of the managers, the board of directors, and any other stakeholders that are involved with the firm. And similarly, the accountabilities of various sets of people, okay, for what all things managers are accountable for, the board is accountable for, and what are the metrics? What are the metrics that define the accountabilities of each of these participants in their roles and responsibilities? And you make sure that every deal is treated in a fair and equitable manner between the shareholders, the management, and the board, and any other stakeholder in the process. And you bring out this particular governance objective should bring complete transparency and accuracy in all disclosures regarding operations, performance, risk, financial position of the company. All these things have to be taken care of in an effective corporate governance practice. And this part is well known to all of us. The different business forms, we have three key forms where we call them as sole proprietorship, partnership, and even a corporation. Sole proprietorship, there is only one owner. Partnership, two or more people to start a business together, means two or more owners. Whereas when we talk about a corporation, the biggest benefit is the owners and the corporation are different. It's a separate legal entity from its owners. And some of the things which we might have already known about all these forms. In sole proprietorship, we talk about unlimited liability, limited ability to raise capital, and very difficult in terms of transferring of ownership and all. The same is the problem that comes with the partnership. And in both these things, you can see that the owners and the management, both of them in general will be one and the same. Whereas that's not the case with respect to a corporation. Owners are different and management is different, because most of the times the owners invest in the corporation in the form of as shareholders, and they may not play a big role in the day-to-day management decisions. So they hire managers to control the day-to-day operations, and also to deploy the assets of the company very effectively. This is where the conflict of interest comes up, which means there is a potential for a conflict of interest only in case of corporations, but not in case of sole proprietorships or partnerships. So that particular problem, which is bringing out the conflict of interest between the owners and the shareholders, is typically defined as the principal agent problem. It's basically like, principal has hired an agent, which is nothing but the shareholder has hired a manager to work on his behalf, but this manager has powers. So what this agent does is he try to execute certain tasks and projects which will benefit him more rather than benefiting the principal. Right? Because he is also given some kind of targets. He is having his own key performance indicators, which will add as a part of his appraisal process. So he would like to execute those tasks which are going to increase his value rather than that of the shareholders, and this is what will cause the principal agent problem. So most of the times we see that the principal agent problem comes between two sets of people. One is the management versus the shareholders, and the second is the directors, board of directors, who are appointed to act on behalf of the shareholders versus the shareholders themselves. So when I am talking about the kind of conflict of interest between the managers and shareholders, the major areas they come up are, the company using the funds for an expansion process. So management signs the deals to expand the business, because as the size grows, probably the manager will get his own perks. The manager will get some kind of reputation. So the managers typically feel like using the company funds for expansion at a drastic rate. And when it comes to compensation, the salaries, the perks, the stock options, they try to allot more and more to themselves, which will be a big problem with respect to the shareholders. And at the same time, the company may think of investing in risky ventures, or even not even taking a risk, either of the extremes, rather than operating moderately. For the simple reason, if they invest more in risky ventures and if it is a success, probably the profits are going to come out much more, and the compensation of the employee is going to go up drastically. And if they don't take much of the risk, obviously there is no chance of losing. So all the extremes are possible in case of management decision. So that is where there will be a conflict of interest between the managers and shareholders, because the activities or the decisions which the management is taking may not be with the intention of maximizing shareholder wealth. They think of taking up some negative NPV projects. So, if they are taking up negative NPV projects, it may so happen that the individual shareholders may not be willing to go ahead, which means they don't want to take the risk. But the management wants to take very utmost risk because of their personal benefit. So, these all will cause some kind of conflict of interest across the various stages. The same way, when we talk about the conflict of interest between the directors and the shareholders, this comes only under one major situation. The directors should act actually more on behalf of the shareholders, but they end up acting more on behalf of the management. This is where a conflict of interest comes between these two parties. For the simple reason, if this set of people logically they are not independent and they are very much related to this management, either through personal relationships, family relationships, or even business relationships. Whatever, if at all these directors are more and more related with the management, you find that they try to align themselves more in line with the management rather than aligning themselves more in line with the shareholders. Or there could be some kind of situations with respect to linked directorships or cross directorships. So this person is a director, board of director of this company, and this person is the board of director of the company which one of these directors is owning. Such kind of cross directorship kind of scenarios, if they are there, obviously the directors are expected to take decisions or act on behalf of the management and not the individual shareholders. Or similarly, if I am paying more and more compensation to my directors, even that is going to create directors acting more on behalf of the management. So all these things will cause a kind of conflict of interest between the shareholders as well as the directors. So just to identify as a part of good corporate governance practice, what are the key roles and responsibilities of the board of directors? Their main intention is to come out with effective corporate governance practice and make sure that the firm is compliant with all the legal and regulatory requirements every period. In a timely manner, the company is compliant with all the legal and regulatory requirements. Set up the long-term objectives of the company from the perspective of shareholders' interests. So, any investment decisions, any kind of business expansion decisions, make sure that the management is taking those decisions only in the best interests of the shareholders and not their personal interests. So, identify and document clearly the responsibilities of the management and how that particular responsibilities are measured and how the performance of each and every management is evaluated, including the CEO. How do you evaluate the performance of the CEO? What are the key performance indicators of that particular CEO? How do you measure the or how do you justify the salary and other compensations that you are giving to this executive top management? All these things have to be understood, or all these things are the key responsibilities of the board of directors, and it should talk to the management and make the management supply the complete and accurate information for the board to process the information better and act on behalf of the shareholders, and make sure that all the members of the board are adequately trained with respect to this corporate governance procedures, and plan for the meetings on a regular note, and if there is some kind of an emergency, even extraordinary meetings need to be planned out for. and even some of the other things which we generally see are the responsibilities of the board is who is the next CEO. After this person who is going to be tipped as the next CEO, do a proper succession planning. It's not a hereditary kind of a mechanism that Y takes over after X. The Y who is the son of X, he may not take over X. So succession planning for the CEO is a very important aspect, and all the proxy issues where whatever are received as a part of the shareholders vote, whatever the complaints, grievances, anything that are received through the proxy process, all those things need to be addressed immediately, and it should be made sure for the board to be more and more effective. The chairman and the CEO are separate positions. CEO cannot be on the board of, or even if he is on the board, he cannot be the chairman of the board, because this will create the possibility of a compromise between the roles and responsibilities. So it is clearly stated that if the CEO and the chairman positions are different, it would be much better. And it's also a good thing that the board of members have some shares of the company, right? If the board of directors have the shares of the company, so they will also be more or less similar to that of individual investor who is not working in the day-to-day operations. So because the board member also holds some of the shares, it's a great chance that he will try to act on the activities that will benefit the shareholders, because he himself is a shareholder. So it is always advised that the board members have some number of shares. Again, too much of shares which can influence the complete management decisions, and where he can benefit to himself, those things may not be advised, but at least having some number of shares, just like any other individual regular investor, even if the board members hold some shares of the company, it will help them to act in the better interest of the shareholders, because they will try to act in their own better interests. And any insider transactions or related party transactions like loan to CEOs or anything which are even the business dealings between the various related parties of the company, it's not that you can't do those kind of businesses, but it requires an approval of the board very much in advance, and the board will evaluate that and finally come out with the decision. And it's also a good practice that one of each board member is not a part of more than 2 or 3 boards of other companies, because this particular person needs to give some kind of advice and needs to spend some amount of time on the operations of the company. So if he is on the board of multiple companies, probably the kind of dedication he can show to each one of those companies is not that much, which is where it is though not mandatory, it is advised that one particular member at a point in time, he is not on the boards of 2 or 3 companies. And this board will set up an audit committee which is more responsible for day-to-day auditing of the financial practices, the business practices of the company. So this should be a complete independent committee, and it should have full access of the cooperation of the management. All the internal auditors of the company, it's better that, or it is a good practice that they should report directly to the audit committee, and this audit committee should be an independent committee. And make sure that at least 2 members of the audit committee have the relevant financial and accounting and that specific related experience, and some of the good practices are the audit committee should at least meet once in a year with all the auditors, but of course without the management. So that's the way. If the audit committee is working, this is more and more independent, and it looks like it is working on behalf of the shareholders only. So, from an analyst standpoint, what all the things that the analysts need to look at? Frequency of separate sessions for independent directors. When I say separate sessions, how many times are the directors meeting without the management? Is there that kind of independence in terms of the decisions? Any skip level meetings that are planned for where the management does not play a role? And the legal counsel, it's not the one of the management or the company, it's not an in-house counsel, but is the board referring to an external or independent legal counsel for various aspects? What is the composition of nominating committee? How many internal people and how many external independent people are there? Same thing with the compensation committee. What is the composition of that compensation committee, which is deciding the salaries of the executives and other management team? How many of them are internal people and how many of them are external independent people? And is the board having a staggered or annual elections? If it is a staggered form of election, probably one board member may be there for so many years on the board, which could very much result in he getting more or less colluded with the management, and the decisions taken by him can be more and more biased. So the good corporate governance practice suggests let the elections be held annually, so that the board members don't serve for more than a few number of years on the board of the company. And if he is serving for more number of years on the board, there is a good chance that a big rapport is built between the management and the board, which can help the board or the director to compromise on the activities of the management. So those are some of the things which the analyst needs to look at. And whenever we are looking at the statement of corporate governance, the focus should be on the code of ethics of the company, wherein we look at the values, the responsibilities, what are all those things which the company has highlighted. How does the relating the tasks of the directors in terms of monitoring and reviewing the responsibilities, and what are all the things the management is responsible to furnish to the board. The oversight thing regarding the internal controls which the company is putting up, the risk management which the company is putting up, accounting disclosures, the nominations, all these things. Board self-assessments is one important thing which the analysts need to look at. How well are the directors trained on various aspects relating to the performance of the company, and how do you assess the performance of the management? All these things have to be looked at as a part of the statement of corporate governance of the firm by the analyst, to make sure that he is suggesting a good company to his clients from an investment standpoint. It is not sufficient that the value of the company or the financial statements of the company are good enough so we can go ahead in terms of investment, but the financial statements itself are possible for complete cook-up. That is what we have been seeing over the last few years. So right now the financial statement may look more and more rosy, but it would have been a cooked up financial statement. So that's where it's better to always look at the corporate governance practice, the code of ethics kind of practices within the organization, to make sure that the management is acting or management is displaying whatever is in the best interest of the shareholders and not hiding any such kind of information. Apart from those regular risks and all, there is an increased focus on three other types of risks which typically are non-traditional, but today they are impacting more and more. Environmental risk, talking about emission norms, the climate changes, any new laws that the government has passed, new regulations that the government has passed regarding any of these emission norms and all, or and is the company adhering to all those things, or any kind of deviations or violations possible in that regard. Then there is a focus on social risks, which are more to do with the safety at the occupational place, the fire safeties, and the labor risks, the unique risks or exclusive risks that the labor are facing, majorly with respect to any see, that could be very much possible from the legal perspective. Any lawsuits that are filed against the management, failure in implementing occupational safeties or labor related welfare of the laborers, anything, if the company has failed and a lawsuit has been filed, it's going to impact not only from the financial perspective. It could have a very big impact on the reputation of the company. It could have a financial impact on the company, and it could even impact the operations, because people, once the safety is not there at the workplace, probably people may go on a strike, people may not work for full potential. All these things could definitely come up, which could have a lot of impact on the profitability of the company. So nowadays there is an increasing focus for ESG kind of risk management, the environmental risk, the social risk, and the governance risk aspects of the firm. And when we look at from a valuation dimension, obviously the good corporate governance, there is a good chance that it can lead to high profitability, which can increase the value of the firm. But if at all the corporate governance is not good, we can definitely say that it will reduce the shareholder value, and a few more risks can come up. As far as corporate governance is concerned, we can classify the risks into 2 or 3 major aspects: the strategic policy risk, the financial disclosure risk, and the asset risk. These are all more associated with the corporate governance. When I am saying asset risk, managers and directors using the company assets for their own personal purposes rather than for the benefit of the shareholders. So this asset risk is a kind of weak or poor corporate governance practice. Financial disclosures, whatever is the financial statements they are making or preparing on a quarterly or an annual basis, they don't reflect the accurate information of the current position of the company, which means there are so many cook-up exercises that are happening in the financial statements, which is giving rise to this financial disclosure list. This is also a kind of outcome of poor corporate governance practice. Then we are talking about a strategic policy risk, wherein the business transactions are entered not in line with the interests of the shareholders, but they would result in huge payoffs for the managers and the directors. So those kind of deals and transactions are entered into, wherein the benefit is not for the shareholder, but the benefit is for the management. That is what is contributing to the strategic policy risk. So corporate governance, if it is not up to the mark, it can result in all these additional risks for the company, which could have a very huge impact on the profitability and thus the value of the firm. So it's better for us to understand the as a part of the investment decision making process, not only the numbers and the profitabilities and the valuation aspects of the company, but also the corporate governance aspect of the company, because it will make sure that whatever we are interpreting in terms of numbers from the financial statements of the company, they are all accurate, they are reflecting the actual position of the company, and the company is acting on behalf of the shareholders. That will enhance the investors' confidence in going further and investing in that company. I hope this session has given you a brief idea of the typical corporate governance practice in an organization. In case you have any further queries regarding the same, you can get back by giving me a call on the number that I have given below, or you could even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.